Out. Good morning, everybody. Good morning, everybody. Today is Friday, the 13th of October, 2023. I hope you guys are well. Top story this morning is we have got the big banks. The earnings has come in today. The big banks all posted big beats. Not too surprising there. We were expecting the big banks, or at least I was expecting the big banks probably weren't going to light up the board or anything, that we weren't going to see any big moves. I haven't really been expecting any big problems with the big banks. The one exception there being Bank of America has a lot of unrealized losses on their balance sheet. Also, I've heard a lot about Charles Schwab might be on the fence. But really, I was expecting good earnings from the big banks. It's the little banks that I'm worried about. And the little banks we haven't heard from yet. And the fact that the big banks are doing so well might be a bad sign about the little banks. I know, here's Jack finding the negative in every positive story, right? This is just how I roll. But the story is JP Morgan, Wells Fargo, Citigroup all post big jumps in earnings. Why are they doing that? Because interest rates have gone higher. So these big banks are charging much higher interest rates on the loans that they're making. They're making fewer loans, but they're charging a much higher rate on those. Plus, they're parking a lot of money in reverse repos and getting 5% interest from the Fed just for leaving the money there. So they're making all the extra money from higher interest rates. But because the big banks are perceived as safer versus the smaller banks, i.e. too big to fail, a lot of the money has fled these smaller banks for the perceived safety of the bigger banks. And so the big banks have not had to increase the interest that they're paying out on deposits. They haven't had to raise their CDs or their savings or checking rates. And so the big banks have been the chief beneficiaries of all the turmoil from spring when Silicon Valley and Silvergate and Signature and all the other banks failed. The smaller banks, when they started to struggle, the money started fleeing the smaller banks into the bigger banks. That has allowed the bigger banks to make more money on loans while paying less money on deposits. So one interpretation, or at least my interpretation of the big bank earnings is, yeah, this is good and the market might have a good day because of that. But that also means you got to watch out for those small banks, because I suspect this is not general prosperity in the banking sector, that these good quarters from the big banks is really just being driven by the good quarters or by bad quarters from the smaller banks. Now, also going on this morning, we have got another big story coming out of the Middle East. Guys, I just have to preface this by saying this is a finance channel, so we're going to view everything through the lens of stocks, bonds, commodities, finance. All right, it's not meant to belittle the humanitarian cost of what's going on over there. It's just what we do here. Now that that's out of the way, we've got a big spike in oil prices this morning because Israel has given Gaza City 24 hours to evacuate 1 million people. And you can't really move 1 million people in 24 hours, guys. It's not how that works. You got old people, women, kids. It's just, you can't move that many people that quickly. Basically, Israel has started the clock. They have said within 24 hours, we're going to be rolling on the ground. Everybody has been expecting this. The tanks, the troops, they've been massing along the border with Gaza. We've all seen this coming. And now they're saying you got 24 hours, get everybody out of there. They're basically saying the whole northern half of the Gaza Strip needs to be evacuated before they roll in. They're going to level the place is what they're probably going to do. And of course, that is an early indicator that there's bound to be a humanitarian crisis here, right? When you displace 1 million people, they have to eat, they need water, they need everything else. So you've got a massive humanitarian crisis forming in Gaza. You already have one with the bombing that's been going on and with the terrorist attacks that have been going on. It's going to get worse when the tanks roll in there. So that has everybody worrying about escalation. All right. Escalation meaning bringing other countries in. When 1 million people are kicked out of their homes, do you think the Iranians are just going to sit there? Do you think the Saudis are just going to sit there? And if the Iranians and say the Saudis or the Syrians or the Lebanese or Hezbollah or any of the other actors in this play, if any of them get involved, do you think that U.S. carrier that's sitting in the Eastern Mediterranean, are they just going to sit there? So the place it's a tinderbox. It's a powder keg. It's always been like that. But now it's a powder keg next to a bonfire. All right. All it takes is one spark to land in there. And next thing you know, it ignites and it spreads. And that's got oil markets really weary this morning. Oil prices are rallying on this news. And we'll talk about that a little bit more. And also, there was turmoil in the bond market yesterday, not getting a lot of coverage. But that 30-year bond auction that happened yesterday, there weren't many takers. Guys, there was big trouble brewing in the bond market. We're going to get into that. Basically, the bond market was a failure. There's no other way you could describe this auction. The primary dealers had to take home 18% of the 30-year bonds that were offered by the government yesterday. Typically, the dealers take home about 10% has been the average this year. So, case in point, there just were not enough buyers for those new bonds that were issued by the government yesterday. And something I've been saying, all the biggest historical buyers, the Chinese, the Japanese, the Federal Reserve, they're all net sellers of bonds right now. Fewer buyers, more supply, prices go lower, yields go higher. And that's what we saw yesterday. Interest rates moved sharply higher yesterday. But of course, they are reversing course now this morning because of the turmoil in the Middle East. You've got people are saying, oh, look out what's going on over there, World War III. Let's pile into bonds for safety. So you've got a lot of volatility in bond market, guys. Things are messy right now, to say the least. With that, let's shrink my big melon of a head. And while we're doing that, won't you please like this video, guys? It really helps with the YouTube algorithm. And if you're new here, subscribe and come back, sit with us every morning and have your coffee with the melon heads. We do this every day. CNN Fear Greed Index is in the middle of fear territory at 35. That's up a little bit from recent lows, but still well in the fear territory. We've got the S&P is looking like it's up a little bit this morning, 16 points to the upside. That's likely being propelled by those big bank earnings, up about 1/3% ahead of the opening bell. And I just want to show you guys yesterday, we don't have anything yet for today, but here is this. Let me bring up my mark. We got this nice bounce off the 200-day moving average a few days ago. I suspected we were going to come up and test the 50-day moving average. We didn't quite make it to the 50-day. We took a big slam down yesterday, but it looks like the bank earnings today might give us a little bit of a bounce. Watch this level right here, guys. I know I'm getting a little sloppy with my drawing, but watch that level of about 4,400 on the S&P 500 for resistance. I don't think we go much higher than that. This whole rally that started last Friday, in my opinion, it has been nothing more than a technical bounce. I don't think we go above the 50-day moving average before resuming lower. Looking over at the Dow, that is up 130 points pre-market this morning, about 0.4% higher. Again, big banks, also United Health, are propelling that one higher this morning. United also posted a pretty good quarter. And the NASDAQ is up 31 points or 0.2% higher pre-market. All stocks up across the board this morning, but NASDAQ not quite doing as well as the other indexes. I also want to show you guys on the NASDAQ chart, important level to watch here. Let me zoom in a little bit. There's your 50-day moving average shown in blue. We closed above that on Wednesday. We were above it for a while yesterday and ended up closing below that level, now trading right around that 50-day moving average. That's another important technical level to keep an eye on. Looking over at the U.S. dollar, the U.S. dollar absolutely ripped higher yesterday. Just an amazing day for the dollar. That had a lot to do with forcing stocks lower. That came on the heels of that higher than expected CPI that we got yesterday. This morning, it's pulling back a little bit. You've got the U.S. dollar is down about 18 basis points, currently at 106.42. Now, looking at the U.S. dollar chart, again, kind of a technical bounce here. We've seen a couple of these as this thing has been rolling up. We had a little correction down to the 200-day moving average. That was back in August. And then we moved higher. Now we've got another little correction ongoing. Was yesterday the end of it? Look at that big green candle up yesterday, giving back some of that today. I suspect the dollar is going to continue higher. The one thing to watch with that dollar as it moves higher, keep an eye on the People's Bank of China and keep an eye on the Bank of Japan. Those two countries have a lot of dollar reserves that they could dump to try to defend their own currencies, which are weakening right now. Everybody is expecting the BOJ to get involved at some point here. That could send the DXY lower if that happens. But unless that happens, I suspect the Dixie continues to move higher. Looking over at the bond market this morning, there is a lot of red in yields. This is bond prices moving higher. Remember that when you see a yield moving lower, that's the bond price moving higher. People are running for safety this morning, perceived risk because of what is going on in the Middle East. You got the 30-year yield is down 11 basis points. That's after it ripped as high as 16 basis points higher yesterday, now giving back most of that. The 30-year is yielding 4.755. We've got the 10-year yield also down 11 basis points, yielding 4.597. The 2 years at 5.02%. That's down about 5 basis points. And the 1 month is yielding 5.434, up almost 2 basis points on the short end of the curve. Check out the 10-year yield, guys. Again, something very similar to that Dixie curve. We've seen it's moved higher, came back, tested the 50-day, moved higher again, tested the 50-day again, came back, moved higher. I thought we were probably going to test that 50-day moving average, but that bond auction yesterday ruined plans for that with that big green candle. Although with the conflict in the Middle East now, a lot of volatility in the 10-year yield right now, guys. This is the most liquid asset in the world, the 10-year U.S. Treasury. It's not supposed to trade like this. You're not supposed to have 10 to 15 point intraday swings on the U.S. 10-year Treasury, but that's what we have. Volatility is an indicator of an illiquid market. Now, let's talk about what happened in bonds yesterday, because this was big. Not a lot of coverage of this one, at least not in the mainstream press, because bond auctions don't usually get a lot of attention. The 30-year Treasury had an ugly auction. What's behind the weak demand? An auction of the 30-year Treasury debt on Thursday is the latest warning signal that demand for U.S. government bonds is sinking. At the Treasury auction, primary dealers who buy up supply not taken by other bidders had to accept 18.2% of the debt on offer, the most since February of last year. The average this year was 10.72%, according to Dow Jones Market Data Team. So what happens with these bond auctions is typically the government puts this stuff up for auction. Anything that doesn't get bought up by investors, by pension funds, by everybody else, the banks, the primary dealers, which is pretty much the big banks, they have to buy everything that's left over. That's the cost in exchange for all the fees that they collect for putting on these auctions. Well, typically the banks have to take home a little more than 10% of everything on auction. Yesterday, they had to take home almost twice that. 18.2% of everything that was offered in the 30-year bond yesterday had to be taken home by the dealers. There was no appetite for this stuff. The highest yield accepted in the market for the 30-year Treasury bond on Thursday was 4.837, nearly 4 basis points higher than the yield anticipated before the auction. The gap between the anticipated yields and the highest accepted yield is called the tail, and higher tails at auctions, in plain English, indicate that government bond issuers had to entice investors with a premium over the market rate on bonds to place their debt. Bigger tail means there were not enough buyers. The interest rate had to rise until the buyers materialized. Not many did, and so the primary dealers had to take home everything that was left over. People don't want U.S. government debt anymore, and the U.S. government is issuing more and more of it every day. If there are tons of folks looking to buy, that yield would be a lot lower, said Chris Gunster, partner and head of fixed income strategies at Fidelis Capital. He told Barron's, it suggests demand isn't matching expectations. That's your one takeaway from this story, guys. Forget the tail, forget the mechanics of the bond market, forget the dealers taking home. There is not enough demand for U.S. government debt to meet the supply of it. That's why you need to pay attention to what's happening in Congress, to what's happening in this battle for the Speaker of the House, to what's happening with these spending bills and the military aid packages, and a few billion for this country, a few billion for that country, a few billion for infrastructure, for this, for that. Anybody who wants to cut spending wants to throw grandma off a cliff, right? There is not enough appetite for U.S. government debt to buy it all, and the government keeps issuing it, which means the price of U.S. government debt is crashing. That's why interest rates keep moving higher. Yeah, the Fed is doing what they do on the short end of the curve, but the interest rates on the long end of the curve are moving sharply higher at a rate we have never seen before. This is a problem, guys. Nobody wants to buy government debt. And I just want to point you out, the clock is ticking on this. Reverse repo dropped again yesterday, big time, now at $1.157 trillion in reverse repo. This is the extra cash that is available in the bond market, and this is dropping like a stone. When this gets to zero, all hell breaks loose in the bond market. That's when interest rates go vertical. And guys, I just want to point out the reverse repo right now, this is a trend going out to about, what was this, last June. Look, as soon as the debt ceiling debate was over earlier in the spring, this thing started to drop. It's kind of taking the stairs down here. We've seen this a few times now. And its current trajectory, if this pace continues, and I have no reason to suspect this pace will not continue, this pace might actually steepen, especially if we're going to send hundreds of billions of dollars in military aid to even more countries now. If this continues to drop, the reverse repo runs out of money sometime around February of next year. And when reverse repo runs out of money, there's no more extra liquidity. So that's when the Fed has to create some new supplemental economy like the Western economy's supplemental universal collateral program, aka We Suck, where they just print money and buy up U.S. government debt. At that point, when the reverse repo gets to nowhere, either the Fed starts to monetize the debt by printing money to buy government bonds, or interest rates go straight up vertical because the government sticks its hand in the bowl to borrow money from the bond market, and there is no money in there to borrow. One of those two things happens when this gets to zero, and right now that's on pace to happen by February. Looking over at the commodities board right now, gold, December gold futures at $19.21. That is up $39 this morning, 2% higher on gold. Gold is loving this turmoil in the Middle East, guys. Again, not to belittle the human aspect of what's going on there. This is just a finance channel, so we have to put it in these terms. As U.S. Treasuries become less and less of a safe haven asset because people are starting to worry about the government solvency, gold and silver are reacting strongly to that. And today yields are down. That's also propelling gold. So we have got gold is sharply higher by 2%. December silver futures up 2.75% right now at 22.56. That's up almost 60%. Congratulations to my silver bugs on that one. We've got platinum is down by about platinum is up by about 1%. Palladium is down by about 0.5%. And crude oil, West Texas Intermediate at 86.36. That's up almost $3.50 this morning. 4% to the upside for oil. Big move in West Texas Intermediate. That is despite these big inventory builds that we've seen in gasoline and crude oil inventory these last few weeks. That is how seriously the market is taking the situation in the Middle East right now. And I want to talk about this one in Barron's today. Israel warns northern Gaza must be emptied within 24 hours. We're talking about 1.1 million people have to move in one day. This is not going to be easy. This is a humanitarian crisis in the making. Again, not taking sides in the conflict here or anything like and there's no matter what you say, you're going to piss off somebody when you talk about this one. So let's just get through it. Israel on Friday gave Palestinians 24 hours to leave Gaza City ahead of an expected ground offensive in retaliation against Hamas for the deadliest attack in Israeli history. The United Nations said it had been informed of the evacuation order shortly before midnight on Thursday, 6 days after hundreds of Hamas gunmen broke through the militarized border barrier around Gaza and killed more than 1,200, I've heard 1,300 in Israel, drawing comparisons to the 9/11 attacks in the U.S. The UN said the mass relocation affecting 1.1 million, or about half the entire population of the Gaza Strip to the territories south, was impossible and urgently appealed for the order to be rescinded. The tanks are going to roll soon. There's 1 million people in the way, and Israel said you've got a day to get them out of there. This is going to be a mess, all right? And this is going to escalate the conflict. And again, over 1,000 civilians massacred in their homes. It's hard to describe anything as an escalation beyond that. But the numbers involved here just get a lot bigger when these tanks get rolling, guys. And I just want to mention this line here. This is in another article in Bloomberg this morning. An escalation of Israel's war with Hamas, drawing in Iran, could send crude oil to $150 a barrel and cut about $1 trillion off of economic output. That's according to Bloomberg Economics. Now, what are they talking about withdrawing in Iran? Iran funds Hamas, right? All these weapons, all these bullets and guns, everything that was used to kill all these innocent people in Israel last week, they were all supplied by Iran, which means they were all paid for by Iranian oil. All right. Also, Hezbollah to the north in southern Lebanon, everything that they've been lobbing into Israel, that's all supplied by Iran. And that's why you need to keep an eye on this story. Now, there has been a lot of talk about this $6 billion that was unfrozen recently as part of this prisoner exchange. And guys, I can tell you this $6 billion is a red herring when everybody's talking about, oh, we just gave the Iranians $6 billion. It was their money. We unfroze it. And then they're using that to fund these terrorist attacks. Okay, maybe not really, because that money's still sitting in Qatar. It hasn't actually made it to Iran. But compared to Iran's oil sales, that $6 billion is chump change. Because since 2021, Iran's oil sales have exploded, even though the sanctions have still been in place. Technically, it's still illegal for any companies we do business with to buy oil from Iran. And we've been basically letting it happen. Well, we needed oil prices lower to save somebody's poll numbers last year while we were dumping the Strategic Petroleum Reserve. We were also letting the Iranians sell all of their oil, even though we have sanctions in place that say because Iran is a global sponsor of terrorism, they're not allowed to sell that oil. We've been letting them sell it anyway. So while we're sitting here fighting over this $6 billion, $60 billion of oil has been sold by the Iranians to mostly China recently. And so this is the big question about oil prices now. Biden's choice, let the Iranian oil flow or watch prices rise. So forget that $6 billion in Qatar right now. We still have these sanctions on Iran. We have not been enforcing them. If we decide to suddenly start enforcing them, that's something like 4 million barrels per day of supply that will disappear from the market if we decide to reimpose those sanctions. By reimpose, I mean they're already in there. We're just not enforcing them. Well, that would send oil prices sharply higher if we did that. If we don't do that, then we're going to continue allowing Iran to sell all this oil, and Iran will use that money to buy bullets and rockets and everything else and give them to Hamas and give them to Hezbollah. So we have a choice here between higher gas prices at the pump or sponsoring terrorism, financing terrorism. Either way, this probably means oil prices are going higher, guys. And take a look at the oil chart this morning. Here we go. U.S. oil prices currently just below $86 for West Texas Intermediate. Zooming in again, there's that 50-day moving average. Once again, right here, bouncing up and down around that one. We came down off our highs recently. We had all of that big inventory build in gasoline last week. Data that I was questioning that data, but then we got the more EIA data yesterday. It looks like those inventory prints were accurate after all. Well, we bounced above the 50-day moving average, came back down below it, and now we're back above the 50 again this morning. Don't really know what's going on here, but I can tell you if that conflict in Gaza escalates, if those tanks do roll in, if they forcibly relocate over 1 million people, the other Arab countries are not going to sit idly by while that happens. There will be some kind of weaponization of oil. You can bank on that. And even if the other Arab countries don't, the United States may weaponize oil by enforcing the sanctions on Iran. Either way, there's a very good chance oil prices are heading sharply higher from here. And that's why I took out a position in ERX this week. That is a levered position, highly risky trade, but that's worth keeping an eye on. And all right, let me see how much time do we have. Yeah, we can talk about the banks here. We're going to go through it real quick. Big banks posted really good earnings. JP Morgan's Jamie Dimon says this may be the most dangerous time the world has seen in decades. Kind of sharp language from a guy who just posted a good quarter, but banks turned in better than expected profit, helped by higher interest rates. Not going to get into the numbers here. These were big beats, but JP Morgan is a lot bigger than it was a year ago because it bought up all those assets from First Republic, and it's been making a lot more loans. They've had a lot new deposits come in. So the year-over-year comparison to JP Morgan's earnings, not really comparable. The main takeaway here, the big banks have been the biggest beneficiary of this regional and small bank crisis because all the depositors are fleeing those smaller banks because they're afraid that the FDIC is going to let them fail. And they're moving their money into the bigger banks where they think they're safer. The bigger banks have all the same problems. They're just more likely to get bailed out by the feds. So the money is flowing into the bigger banks. It's allowing the bigger banks to make more loans and earn more interest, while at the same time not raising the interest they pay on those deposits. So that's why these quarters have been so good. I expect when the little banks start reporting next week, that's when the fireworks really start. But right now, this morning, we have got JP Morgan is up 1.2% pre-market on their earnings beat. Wells Fargo, they also beat earnings. They're up 2.2% pre-market. And Citigroup is up almost 3%, 2.8% higher pre-market. For Citigroup's earnings, big banks, big beats, all at the expense of their little cousins. I suspect that is what's driving this story today. And I just want to say thank you very much to all of my Patreon supporters, guys, for everything you do for the channel. I appreciate that very much. Thank you, everybody, for spending your morning with us, having your coffee with the melon heads. Also, this is Friday afternoon, which means we will be back at 3:15 p.m. Eastern time today for my weekly wrap-up live stream. Looking forward to talking to you guys then. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.